Hi, thanks for joining me. Today we're going to talk about the all-in-one loan and how it might benefit you in a refinance scenario. Lots of talk right now these days about refinancing your mortgage. And before you do so, it might be worthwhile to look at this product and how it might benefit you, not just in the short run, but the long term. And so if you've watched this before, if you've learned anything about our proprietary loan, the all-in-one loan, you'll first realize that it is very different. It's not for everybody, but it's important for everybody to know about it. And especially if you've got an existing mortgage and you're considering modifying that, refinancing it, let's take a look at this product. And in your particular case, as we dive through this, we'll see if it might be a better fit. And CMG has put together a very robust, intuitive online simulation modeling tool that we will go through for all of our clients to dive into your specific scenario, your specific financial profile, and how that's going to translate to this product. And so today we're going to spend some time looking at just doing a rate and term refinance, we call it, where we're going to say, okay, here's your current rate, here's your current mortgage, and if we refinanced into the all-in-one, how that might benefit you. So looking forward to working with you on this, and let's dive into it. So with our online simulator, it gives us the opportunity to do a variety of different scenarios. And in this case, like I had mentioned, we're going to look at just doing a rate and term refinance. And what that means is we're just going to modify the existing mortgage you have, and in this case, put it into the all-in-one. And so we will have the opportunity to also compare it against your existing mortgage, or perhaps what you might be looking to refinance it into from a traditional 30-year fixed. And then compare that to how the results are going to come together with our all-in-one. So if we're looking at a scenario here in the Pacific Northwest or anywhere in the country, we will say, okay, what's your value? What do we estimate your value to be? Because we have to arrive at what's your loan to value. And so for this scenario, we're going to look at a $600,000 balance and an $800,000 value, comes to about 75% loan to value. But of course, we can make these adjustments. We can go up to 80%, even 85%, 90%, depending upon your scenario. But this is a good kind of starting point for us to take a look. And then we're going to say, what's our comparison loan and term? So right now, let's just say 6.5%. And that 30-year fix, and you're about 24 months into it, or about 2 years. And we can make these adjustments as we go. But what we're trying to arrive at is, what is your actual loan principal and interest payment? So this is just calculating what your payment would be based off of these data figures. So you see here, you can look up your mortgage statement, we can run the actual math, but this is what your principal and interest payment is based off $600,000, 6.5%. And if you've been paying this thing for about 2 years, that's your principal and interest. So we'll run through this. The system does give us the opportunity to add a second mortgage, and we could talk about that in a future example, but for now, we'll just talk about modifying your existing mortgage. The next tab we're going to look at is deposits. And the deposits are really the core component of why this product works the way it works. Your deposit activity is going into a checking account. And in our case, the all-in-one loan, we've developed a specialized checking account that is integrated with your loan. And if you think about what a checking account is used for today, it's really just a conduit. It's just a place where your money comes and goes, waiting to be used to pay your bills or your expenses, whatever the case is. But your payroll, all of your deposit activity, your Venmo, whatever you use, it's all going into one place to be liquid, to be used, to sit there for a future use. So what we've done is we've integrated our financing instrument, which is your largest debt, your biggest bill you're gonna have in your house, with where your money is coming for your income. So we're going to look at true deposits here. We're not going to say we want you to change your withholdings or your retirement plan. We're going to say, what are you just bringing home? We don't want you to feel like this is going to change anything than you're doing today with where your money is coming and going. We want this to be representative of your actual deposit activity, your payroll, anything that's going to help make sure that the results that we're going to get today are going to truly reflect not having to make any material changes to your day-to-day or your month-to-month financial situation. So that's what it's really important to be mindful as we go forward. So if we look at the standard prototypical client that might be in a position to have an $800,000 house, two income positions for their household. And we have the opportunity to really change how the frequency of your deposits come in. So that's also important. So when we work through this together with our clients, we actually ask, how frequent are you getting your pay? Because that can change how your results are. If you get paid weekly, for example, there's more frequent deposits. If you're paid monthly, less frequent. So we'll go through that and be very specific with your scenario. This case, let's just use $5,000 every 2 weeks. So someone's got a good standard salary job here. And then we also have the ability to create additional deposits. So if you have a co-borrower or if you have rent or some other type of source of income or deposits, we can reflect that here. So in this case, let's say you've got a co-borrower that maybe has a part-time job or works, just a little bit, just contributing something to the household, but nothing too material. So in this case, we can add them. We can add more deposits as we go forward, but this just gives us a way to really create your scenario as representative as possible. So at the end of the day, what we're looking at is here's your average monthly deposits, and then here's your average annual deposits. And the reason why we want to average that is because your financial situation, your payroll, your expenses, it's not linear. It's going to change. You're going to have times where it might be more or less. So we want to model this out for you to reflect that you don't have to be on this plan forever. There's a lot of things we can make adjustments to and show how that can impact. But at the end of the day, the results of the all-in-one, we want to make sure that it's going to really give you that flexibility. The other component of the screen is one-time deposits. So a lot of us have some reserve money, funds that might be sitting in your savings account, kind of collecting dust at this point, not making a ton of interest, but it's being there to use for emergency or for maybe a future expense that might come up in 6 months. So that deposit activity that might be a one-time deposit, we always just say, if you can park that money somewhere else, would that be a better use of where it's being put? And if you think about a savings account today, you're not really collecting a lot of interest. And even if you are collecting interest, what happens at the end of the year? You're gonna get taxed on it. Any interest, your income you're making, that is taxable. Our all-in-one loan is fully flexible. It's a two-way street. It's a line of credit that gives you access to that money 24/7. So if it's also your largest debt, your mortgage is your largest debt, why not pay down the largest debt with some of that extra savings, that emergency fund? Just park it there, let it sit. It reduces your balance, reduces your overall interest cost, while at the same time still having you have access to it. So both from an access position and also the benefit of not having it, it's not taxed. If anything, it's reducing your taxable position. So in this case, let's say we move 15 grand over. That's just for this household saying, yeah, we've got some money in savings we're gonna set. So we're just gonna show that this money is gonna be moved into your all-in-one, where again, you'll have access to it. The next tab we're gonna look at is spending. And spending is really a core component of how this is gonna work for each individual scenario. Because everybody's spending position is different. Everyone's savings strategies are different. So we wanna be as realistic and representative as possible, while also recognizing that we know this can change as you go forward with your life, with your mortgage. And so in our case, we wanna basically try to make it as conservative as possible. And we can go about this in a couple different ways. We can do what's called a percentage of leftover. Of basically, here is your deposit activity. So your average monthly deposits based off of the deposits that we just went through. If we just use a percentage of that money that's left over after expenses, we can arrive at our results this way. Some folks think that's great. Others want to be a little bit more granular. Let's say we want to get really into the weeds of your budget, your expenses. We can do that. We've built this modeling system out to make sure that we give every client the opportunity to go into this as realistic as they'd like. And some people have their budget dialed in line by line, and credit to you if you do. If not, this is a good opportunity for you to go through that with your family, to go through what is your expense profile. How many Starbucks runs do you have each week? What are you spending money on for groceries and gas or utilities? So we want to make sure that you have a good comfort level with what we're illustrating here, so that again, the results of our product are going to showcase what you do if nothing changed today, just where your money is sitting and where it's staying for as long as you can. So we can itemize this for you. So we typically will go into this saying, hey, if we want to run through this simulator, we want to model this for your scenario. Before we have a meeting, take a minute, take a look at your expenses, pull up credit card statements, your bank records, get an idea where your money's coming and going. And mainly it's when. How frequently are you making these expenses? Because if you think about where expenses come and go, most of them are monthly, right? I mean, we got credit cards, utility bills. The majority of our expenses are monthly. And that means that for the entire month that you're not paying that expense, what's your money doing? It's sitting there, it's waiting to be used to be applied towards these expenses. The all-in-one was designed to basically find a better, smarter, more efficient way to where you sit that money until it's going to be used to pay those expenses. So again, the timing of when your expenses are being paid can really showcase why this product works the way it works. So in this case, we'll keep everything as is, and we're just going to look again at what are we seeing as average monthly leftover. Also on this field screen, you'll also find that we have a taxes and insurance field. So again, we want to make sure we're illustrating and representing what is your taxes, your property taxes, and what's your homeowner's insurance, so that we're capturing those items as well in our analysis. And we'll make these adjustments based on the actual numbers, but it'll default to a certain percentage based off of your loan amount. So in this case, we're just saying, look, we've got an average loan amount, average expenses of about $5,300 a month, which, you know, it's a pretty good sizable expense profile, depending upon everybody's situation. But here's your comparison loan payment. So that again, going back to, this is your current rate, current payment. This is just the math of what your current payment looks like. Then you've got your tax and insurance. That's going to be for whatever loan you do, those numbers are going to be your numbers. You're going to have tax and insurance, whether you're doing a 30-year fix, an all-in-one loan, or whatever loan you're doing. Those are going to be your fixed costs for the property expense. Then we're going to say, okay, how much do you want to reinvest or put into the all-in-one to make this thing work and really showcase the benefit of the product? Remembering that this money that you're keeping in your all-in-one, it's yours. It's fully flexible. It's able to be accessed 24/7. It's just sitting in a place that's going to help reduce the largest debt you have, which is your mortgage in most cases. So in this scenario, just using this about $2,500 from this household is being put there to wait to be used. We're now going to show the results side by side as if somebody was to pay a 30-year fix for the next 28 years compared to somebody modifying their loan into the all-in-one, using the data we obtained from the clients and what the results are going to be. And a lot of times at this point in time, I do say to people, these results might shock you. They might come across like, well, what's going on here? You know, this is too good to be true, or what type of magic, or you know, or what kind of secret algorithm are you guys trying to put here to make me feel like this is right? Remember, this is the math. We're not creating anything different than what we've walked through up until this point. So it's natural, it's normal to have a reaction or a response to results to say, how is this possible? And my response is always, it's how your money is being used. It's how your interest is being accrued over the life of the loan, and why this product is one of the most innovative and compelling loans in the market. And it's been around a long time, so a lot of people just don't know about it, haven't heard about it. It doesn't mean it doesn't work. And so it's designed to leverage your excess cash flow, invest it in a way that's going to help you benefit, to build wealth, and to help you pay off the largest, most annoying debt you got, your house payment. So when we click these results, we're going to see what this looks like. And in this scenario, you're going to pay off that entire $600,000 principal balance in 11.8 years. That's it. And basically, throughout the next 11.8 years, by doing nothing different than what you're doing today, that's the result. But of course, we all know that could change. Or, well, what if this? Or what? A lot of hypothetical, a lot of questions come up. And that's where we as advisors are going to say, let's talk about those. Let's talk about your questions, your concerns. Let's go back and revisit some of the numbers. So this will be a stopping point for us to show, okay, here's what it looks like today. But it doesn't mean we can't make some modifications and change it for hypotheticals. And one of those, for example, is what if you want to go buy a car, right? You know, everyone needs to eventually get a new car, whether we like it or not, at some point in time. Not everybody, but a lot of us. So oftentimes you've got to go through the whole process of getting a car loan, going through the whole credit process to get a loan for a car. What if you had access to capital, your own money, and wanted to just write a check for a car? How liberating would that feel? How would you be able, how amazing would it be to be your own bank? This product allows you to do that. So what we're gonna do is we're gonna go back to our spending tab, and we're gonna look at a future one-time expense. And let's say in a couple of years, you gotta spend 25 grand for a car, or at least a portion of the car, whatever it might be. We're gonna be able to model a future expense and how that is going to impact your results of your loan in real time. So let's take a look. So $25,000, you take it out of your all-in-one, because you've been reinvesting this money diligently each month, parking it, keeping it in your all-in-one, but you want it. You want to take the money out. So when you go and do this, look at what it does as a result. Barely moves a needle. Still is a way better financial scenario and product than a traditional mortgage. So that's one quick example we can show. But let's go backwards here. Let's go back and just look at the numbers as they are. And we're going to go and say, well, how am I paying this thing off so fast? You know, what's the math behind it? So we're going to look at a couple different comparisons of what the interest you're charged over here compared to your all-in-one. One of the first things people say at this point is, well, what's my interest rate? And the response is, well, the interest rate's based off of how long you're going to borrow the money, how frequently you're going to use it, and your balance at the time that money is being used. So in other words, your interest rate is variable, it's flexible, but the cost of your interest is the important question to ask here. And what we mean by that is, what's the cost of interest? Well, when you're looking at a 30-year fixed loan, you already know what your cost of interest is going to be. The first 15 years of a traditional 30-year fixed mortgage, an amortization schedule, it's defined. It's a defined repayment plan that you will know from day one. And the first 15 years of that repayment plan is what? Guess what? Interest. The predominant amount of your payment that you make towards your mortgage is going to interest. It's front-loaded with interest. You can look at the graph. It's like this, where this is all interest, and eventually you start really offsetting it with the principal payment. So that right there, from a math standpoint, is important to remember, because even though we're showing a 6.5% interest rate, the amount of interest you're spending for that money is twice that amount, because you're paying a lot of interest over a long period of time. The all-in-one loan, when we talk about interest rate, we're also going to look at, well, how much actually interest cost? In other words, like how long you're borrowing the money over what interest rate. And we have a way in which we can show you that. So here's your comparison loan right here, principal and interest payment. Here's how much your average principal is reduced monthly. That's literally over the course of that loan, the first 15 years, you're barely scratching the surface interest over the life of that loan. And more so, most people aren't even in their 30-year fixed mortgage for more than 5 or 7 years. They either refinance or sell their house. So the actual time that you're in a mortgage, a 30-year fixed mortgage, what are you doing during that time? You're paying interest. So the comparison of the all-in-one is an important differentiation, because every deposit you make for the all-in-one loan is applied to your principal. And we'll say that again, because that's an important foundational component of the all-in-one, and why it works the way it works is it's the only loan in existence that pays the principal first. Home equity loans, car loans, mortgages, everything else is typically either a blended principal and interest, or interest first, then principal. Our product was designed specifically to capture the benefit of paying your principal at every time you make a deposit. And so this is why you're seeing your principal reduced rapidly, because you are applying it every time you make a deposit that month or daily, whatever the frequency is, right to your principal. So as a result of this, you're paying your principal down exponentially faster. And then we want to look at, well, how do we get to what would be a comparison of interest rate? What is actually being compared apples to apples to a 30-year fix, which is a set defined repayment plan, very hard to define an apples to apples comparison. The way I say it is, it's more like apples and baseballs. They both are round, they both fit in your hand, you can both throw them, but they're completely different objects. 30-year fix is a set repayment plan defined over an amortization schedule. The all-in-one is an open-ended credit line, principal first repayment, daily interest accrual. And that means that every day we calculate how much interest based on the balance. So the longer your balance stays low, the less interest you're being charged. So for us to arrive at a comparison, we say, okay, let's look at these numbers. If you paid this mortgage off in 11 years, 11.8 years, your interest cost relative to an interest rate is 3.11%. So the way we can describe this from a mathematical standpoint is, well, your all-in-one loan, if you'd followed this plan as is today, you'd be paying 3.1% on interest. And if you were to ask me today, hey, Jim, are interest rates ever going to get down to 3% again? I'd say most likely not. But I have a product for you that would achieve the same goal based on your financial situation. And that's what's really exciting about this product, is to explain to people you have a path to pay less interest, create flexibility, and create financial freedom. It's different. It's not something you may have heard about before, but it exists, and we've been doing it for over 20 years. So I'm looking forward to walking you through this specifically to see how it might fit for you. But in the meantime, these are the numbers based off the results. And we have the opportunity to go back and readjust these to make it fit for your specific scenario. But at the end of the day, this product is a game changer for you and your family and your financial situation. And instead of looking to refinance into another 30-year fixed loan where you're going to pay a boatload of interest for the next 15 years, why not consider a mortgage that's smarter, it's better, more efficient, and gives you control of your finances and puts you in control of your mortgage rather than a bank controlling you for your payment. So thanks so much for listening. I'm looking forward to showcasing more of these scenarios with you guys. And reach out, give me a call, shoot me a message anytime. Be happy to walk through this with you. Thanks.